Hey, welcome to the Butterfly and Condor Workshop Q&A. The workshop actually starts tomorrow, but we're going to be talking about butterflies and condors today. Just a really quick overview on some of the strategies and just a little bit answer any questions that you may have. Before we go too far, normal disclosure, Airmere and Stratagem are not broker-dealers or investment advisors. For educational purposes only, options, bonds, futures, and currencies involve risk not suitable for all investors. Past performance is not necessarily indicative of future results. If you want to read the whole thing, pause the recording and go to the bottom of any of our web pages. I don't think you'll see any screenshots from these people that help us do what we do, but shout out to them for all the nice tools we have these days. Not like the old days, right, Scott? So
No, it's like the Flintstones.
yeah, I remember. Oh geez, my first option trades were back in like '82. And I had this service. I was in a Chicago suburb, and it was a little box, handheld box, like aluminum, and it was getting stock quotes with a radio signal, and it was like the old ticker tape kind of thing. So you type in the symbol that you wanted to monitor, and it flashed like IBM at this price, up a penny or whatever. So
In
it was,
'82?
and it was like 82 and 83. It was
Wow,
around
you
there.
were
Yeah.
living like the Jetsons. You know what I would do is back in '87, no, like '89, when I was like going home early, I just had one of those little Watchman TVs. Remember those things for 99 bucks?
Oh yeah, yeah, right.
And then turn into channel 26 because CNBC didn't exist, but channel 26 in Chicago had a little box where it was updating the Dow all day long.
Okay.
That was my technology. I thought I was like living large because at least from the drive from the exchange to home, I at least kind of could keep up with where the Dow was, and if something crazy happened, call the brokers.
Yeah, this is before I joined the Air Force, so it's before '84. Yeah,
Wow.
it's pretty crazy stuff.
Well, you're a gadget guy, so you're gonna know about that stuff before me.
Yeah, that's true. Anyway,
You know,
so
I
just
hear Xbox is coming out one of these days.
oh, a new one.
No, I'm just kidding.
Oh, okay. Okay, so for the workshop, just a quick overview. We got all nine experts teaching different strategies. And Bruno, a friend of mine over down here, he confirmed. So here we're good to go for everybody now.
Now
And
that one
just
guy, Ricardo, I don't have to be able to pronounce his name right.
well, I think it's Murray is his mother's name, and then Sayen's
Yeah,
just
that's that. I'll
Heredia.
never get that right.
Yeah, his father is Spanish. So Ricardo he grew up just west of London, and then when he was in his early 20s, he got I don't know, he met Richard Branson, and because Ricardo's father's Spanish and he's fluent in Spanish, he had him set up an office in Madrid for something. So that's how Ricardo got down to Spain. And then he met his wife, and now he's been there for a couple of decades, kids and everything. But
Right.
he's pretty hot in the Spanish options world. He gave me a
Cool.
video on YouTube that had 10,000 views. So,
Wow.
but he's a native English speaker, so he's fine as far as you don't have to listen to like Ricardo Montalban or something. It's no heavy Spanish accent.
Okay.
So the strategies, just here's a summary of them. Some of them are mostly traded 0 DTE, but you could trade them longer time frames. And by the same token, the short butterfly can be long or short time frame. And most of these, like Bruno's trading the Rhino, he's working for a family office in Barcelona, trading I think 6 or 7, maybe 8-figure trades. So pretty good size. So we'll just go over a couple of these. So the narrow condor, this is what Dan Harvey's trading these days. And it's almost a short, or it's almost a butterfly, but he takes the market price and he goes 5 points either side. So you're getting a lot of theta, and he's doing these 0 DTE. And of course, the market never sits there. So after it moves a little bit, he'll adjust it. It's kind of like this. He'll buy some puts, or that's normally the first adjustment, but it keeps the delta kind of neutral and keeping some good theta. But I think lately he's been doing about 5 lots, about a $15,000 margin, and pulling in 600 to $1,000 a day. So he's doing pretty well with these. It's changed quite a bit. He used to start the trade like this, and then put a strangle on it, so it would kind of look like. See, we can get a different color here. Oops. Oh, I just killed the PowerPoint, didn't I? Do this. Oh, you know what? I'm using that Zoom it from Microsoft System Internals, and it's not letting me draw on the screen, so I'll use Zoom. So when you put a strangle on it, kind of adds some stuff down here. It lifts it up, and then your typo 0 line ends up looking like this. So that's, and typically he would start with, say, a 4 lot and then use 2 strangles. And the strangles that he had before were like 5 points inside the longs. And lately, if he's buying a long, he's actually buying one at pretty much at the price that the market starts at. So it's a much higher delta. So you get a lot of benefit with the delta protection as the market's moving against you. And then that tends to do flattens it out pretty well, because you're buying the put like here or the call. So that's the Nunamaker Condor, kind of a big high level picture. The break-even iron condors is on John Einar Sandvan. Now, he's in Oslo, Norway. I think he's like a marketing executive, and market hours there are 3:30 in the afternoon to 10 o'clock at night. So this is kind of like his hobby during the after work. But what he does is he'll put on a fairly wide condor. I think he's looking for like a 5 to 8 delta range on the shorts. And then he'll put in orders to buy back each side if it gets to basically the price that he paid for it. So if you got $1 credit on this condor, you put an order to buy the put spread back for $1 or the calls for $1. So it'll typically happen, the market will move, and then it'll close out that side, and then it turns it into a short call spread. And he usually does it for you usually lose like 10, 15, $20 on each one. Some people in our 0DTE room that trade this occasionally, though, they like to make it so at least it's positive. But I think John said he has about a 40% win rate, and his annual returns about 40%. So it's fairly steady. I think in 16 months he had 1 losing month. So actually pretty nice. And then the market will occasionally do a U-turn and then take out the other side. And that's usually about a 1x loss, because you basically broke even on the first side. And then if this hits, and you'll also, you'll lose about 1x. The multiple entry iron condors, that's Tammy Chandlis. It's very similar to what John's doing. They'll also put on, I think, fairly wide iron condors. And then she'll start at noon Eastern and put one on every half an hour. She's like a machine, like every 30 minutes, boom, new one, new one, new one. And then she'll also use orders to buy out each side. So whatever she paid for the or whatever credit she got for the condor, and she'll double that and make that her stop price. So if she does have the market take her out, this will actually be a little bit lower. It'll be like John Einar would be closer to 0. She would be like minus 1x, but the market has to move farther to do that. I think the other day she had a pretty bad day where most of them were losers, but most of the time, she's breaking even or making a little bit. And she has a lot of statistics. She's a former architect, and I think she also runs some kind of oil company. She's in the Dallas area. And again, she's doing this. It's not her full-time thing, but it's very popular on the internet. And she's going to be doing an update for us to show us what the current things are and her stats and all that kind of stuff. And then the Rhino trade, this is what Bruno's trading. It starts out like this, basically kind of like an 814. He was doing it like 30 days out. It wasn't, really like short term, like an 814. is basically like a 7 to 10 day trade normally. And then once the market moves, then Bruno will put on the upside like a calendar, and it'll make the T+0 line kind of like this. So it's and the reason it's a rhino trade, it's kind of like the tusk of a rhino, not the big one and the little one. That's why it's called the rhino. People come up with names for all these things. So, but that's basically the how the trade is structured. And I'm not sure, I forget, it's been a long time. Bruno used to run the Rhino trade alert service for me. I don't know, a few years ago, and he found his old slide, so he said he's good to go. I think, and then the spreadsheet that I built, the goat, I call it the greatest option analysis tool, the goat, just as a like a play on words, because in athletes will have like the greatest of all time, the goat. So but that's how we refer to it. And we use it for quite a few things. In fact, I have a copy of it right here. I added this one that basically lets you monitor the at the money butterfly, and then a lower butterfly and an upper butterfly, and you can control the distance of how far from the at the money strike the center of these other butterflies are, and then also how wide they are. But during the day, these will fluctuate. Now, right now the market's closed, and the prices are kind of, I call in the cone of confusion, which is in aviation, you have the nav aids. If you're flying right over it, there's like a cone where it can't really figure out what your heading is to the nav aid. So it gets really squirrely. So the option prices kind of get squirrely. So I just call it's like confused, like that cone of confusion and for flying. But for the short, like if you're doing a short butterfly, you can see what the call and the put flies are trading for. You can do an OCO order. So it doesn't really matter which one you get filled on. So as long as you get filled on one of them, then you can see if this is like 60 cents and that's 50, 80, 70, and that's kind of hanging around 50, 60. You'll probably get filled on around 50, 60 cents on one of them. I did have the other day where I had an OCO order in like this, and they both got filled at the exact same time. So it is possible, but it hardly ever happens.
Wow, you're special. I could never do that if I tried.
Well, I didn't want to, but it worked out. It was a profitable trade. And then
Yeah,
what?
yeah, but anytime, it's been my experience, anytime they jam you with something you don't want, they usually want it back later. And then you get
Yeah,
out for a profit.
yeah, they want your chunk of flesh out of you too. Um, and for the short butterflies, if say you sold this for $1 and you wanted to buy like these a call spread or a put spread back for 50 cents, you can set your target price here, and then these will create the orders like to buy the call spread or buy the put spread, and that'll turn it into a risk-free position at that point with the center or the inflection point of your synthetic call or put at the middle strike of the butterfly. So that's a pretty handy tool, actually. So I kind of like
It
that
does
one.
save a lot of math for people who don't want to go pick the center strike, double it, and then subtract each side.
Right. Yeah, I mean, it's just constant, and it's doing for the calls and the puts.
Right.
So those are the slides that I have as far as like the strategies and stuff. I don't see any questions. So Scott, do you want to share your screen? And I know you had some slides too.
Yeah. Hold on one second. Let me pull up my slides. And okay, can you see it?
I do. Yep.
Wow, I got lucky. I did it right the first time for a change.
Well, I know you said you were going to try out Zoom, so hopefully this is
Yeah, but I'm going to. I was planning on doing it later today. I just inundated with so much stuff because half of my office is on vacation right now.
all right.
So, well, welcome everybody, and thanks for tuning in. Tom asked that I step in and help him out today to give you a little bit of what I'm going to be teaching, because it's a little bit different than what the other subjects are. The other subjects are really great and great instructors. I only don't know one of the guys' names. And
The one you can't pronounce.
yeah, that's why I don't know it. I would give up. I can't
Just call him
pronounce his name. I'm
Ricardo.
not gonna what?
Just call him Ricardo.
Yeah, I will. And that's what I would do, but oh, that's an intimidating name for me. But I mean, Chicagoans have enough problems pronouncing anything to start with. We can't even pronounce the correctly.
That's true.
The is DA. So
The Bears,
the
the
Bears,
Bulls.
the Bulls.
Yep.
So and the worst thing is when I first started in the trading world, half of the time I was on the phone with New York all day long trying to do an arbitrage between the missiles and the S&P. And so I'm talking to New Yorkers all day, and I sort of developed their bad habits too. But anyhow, a lot of great instructors are going to be participating in this, and a lot of the subjects are overlapping a little bit, which is because that's the totality or theme of this class. And mine overlaps a little bit, but then also talks about hedges too. And so it's something I introduced relatively a short time ago, maybe a month or two ago, but I thought I'd share it with you guys in a little bit more detail because it really helps with all the other instructors' positions. This will help with adjusting with the Rhino or it'll help with the mid-width iron condors, etc. So let me just go and explain that. Where I am at is going to be on Monday the 17th, where I go and talk about the short butterfly. And then on Thursday the 20th, which is going to be Newton's Cradle. And everyone's like, what's Newton's Cradle? Well, you've all seen that toy. And that's a Newton's Cradle. Just explains Newton's third law of motion. But the options, I can't think of anything else that explains what this hedging strategy does better than Newton's Cradle, because you buy a spread at one strike and all of a sudden the risk shows up at different strikes. And it really freaks people out. It's sort of like there's a ghost in your position sheets or a monster or something in a good way. And so I'm going to explain that to you right now because it's it does require a little bit of explanation. But and I'll go real fast. I know it's the weekend. Everybody wants to get on with their stuff, but I'm going to be introducing things with the short butterfly and short condors. I know everybody is a big fan of long butterflies or long condors or long iron condors and those sort of things. But in my classes, I've been getting people used to being shorted as well. And that's because every single trade that you do, you have to realize someone's taking the other side of it for a reason. And you have to understand their side of the argument in order for you to make a good decision about whether you want to get into the trade, whether they see that's so great in selling it to you. Now, everybody loves a butterfly because for 10, 20, 30 cents, you get $5 of profit potential. And you're like, well, why would somebody sell me this for 30 cents when they could lose $5? Well, if you trade in the SPX or the SPYs or the OEX or some of the other products, you realize how hard it is to predict the center strike of where the market's going to be at some point in the future. And most butterflies go out worthless. And so I started teaching my students short butterflies. And I went into the short butterfly in several different ways. We went into it to deliberately open a short butterfly. We used it as a hedging tool. We used it in an alchemy class I had where it was nothing but a class about adjustments. We used it with the 0 DTE trades where if you're legged on a long vertical spread, what do you do when it goes against you? Now think about that. When you buy a vertical spread, let's call it a call spread, and the market is about to go up and you get long it, and all of a sudden the market just stops going up and it starts going down. What do you do with that? Or am I the only one that buys a vertical spread right when the market is at the top and then turns around?
Oh no, that's a normal indicator for us when we want the
Okay.
market to go down. We'll buy a call or
It's almost like everybody in the market is just watching my screens, waiting for me to get long. Okay, time to reverse. But
Scott's in, time to go.
Scott's in, the water's warm. So what do you do when you're long with that call spread? A lot of people will either just sell it out at a loss, okay, which is disciplined, because some people won't sell it out. They'll just wait until it expires worthless. Selling it at a small loss when you're wrong, because you entered a stop order in disciplined manner, is the smart thing to do. But eventually our option education advances and we learn there's other things we can do in order to fight another day. Maybe turn it into a butterfly or turn it into a condor. And with the day trading or the 0 DTE trades, this is especially important. And you got to remember that when you're trading any product for that matter, when you get long a spread, if the spread moves one strike against you, the loss that you feel may be 20 cents or 30 cents, but the spread one strike lower will be at the price you originally bought the spread. Just that's how options work. And so instead of closing it out at a loss, sometimes you can sell it, turn it into a short butterfly, and then just manage it, hoping that the market moves away and the butterfly goes out worthless and you don't have a loss. And you didn't buy a butterfly for 50 cents or 60 cents when it has almost no chance of going in the money or at the money. And all you have to do is manage that short butterfly in case it looks like at the close of the day, the market's going to settle around there. And then you got to wiggle out of it. So we were teaching that in the day trading class. And we were teaching with unbalanced condors and stuff like that too. And lastly, in our pod class, we always do a lot of trades and examples. And example 73 was like with the razzle dazzle that ended up with a short butterfly in there. It was like this huge home run that became like 2 pod classes because there were so many lessons in it. But I really started embracing the short butterfly when I was in the trading pits. Okay, this is the pit I was in. And, you know, I was, let me get my drawing tools out. And some of you guys have heard this before, but I spent years, right now, different color pen.
You see it. It's
Can
black
you?
though. Yeah.
I spent years standing right there at the center of the gladiator pit because I can't see worth crap. You can see these guys are all looking this way. And that's because right above your head that you can't see is a big screen. So I stood real close to the big screen because I think Stevie Wonder has better vision than me. So anyhow, it was in this pit that I really started embracing the short butterflies because I just said one day I'm going to see what it's like. Every time I got a loss, I'm just going to make it a short butterfly for 0 and see how my day turns out. And I just had one of those days where everything I touched turned to garbage. And I had like short butterflies on it, like 7 different strikes and only one winning trade, which was enough for me to have a profitable day, provided all these short butterflies went out worthless. And then went out worthless. I'm like, I really started embracing it and playing with it more. And it's been a long struggle to get my students to embrace it like I did, because they look at that risk graph and they hate it. They look at that risk graph of something that looks like this. Well, let's see. Something that looks like And like, the risk reward's not there for me. But you have to also keep in mind the probabilities too. People are addicted to roulette. The probabilities that it's going to land on their slot are very small, but they still play the game because there's a big payoff when it works. It's the same thing here. So I've been slowly convincing my students to embrace the short butterfly. And we've been doing a lot of it of late. And here's an example I did in a real class where on the 23rd of June, and if you guys want, email my office. I recorded it. It's like 34 minutes long. You can watch it real, the real video of it to show that I'm not just making stuff up. I like to validate and because validation causes, creates trust. You guys are more than welcome to watch this. With 10 minutes to go until expiration, I sold this butterfly at $2. And this really makes people uncomfortable because they're looking at it and saying, but 43.50 is a big strike, Scott. And these markets like to close at big strikes. You could, if it closed at 43.50, you're going to lose $5 on the trade. You took $2 in, it's going to be a $3 loss. I'm not comfortable with this. Well, that's the graph of it. They don't like it, especially if it's only $1 or 50 cents. Okay, well, I've also been showing people how to wiggle out of this, and that is Newton's Cradle. How to wiggle out of this other than just going in and trying to buy this butterfly back for $2, $2.50, $3, etc. And when time is running out, people really start to get nervous. If for those who listen to the recording, I want you to sit there and just listen to my voice. And if any of you detect any nervousness that this wasn't going to work out, then don't believe me, because I was very relaxed. I'm talking to the students. I've done it enough times where I've seen the movie. I know how it's going to end. And I felt very, very comfortable with the hedging that I'm about to show you right now. So because I'm short a butterfly and I'm not comfortable with it anymore, time's running out and I could lose a fortune on it, and my students wanted to see how to adjust, I said, okay, it's time to do Newton's Cradle. And so I went in, and you got to remember, in the last couple minutes of trading every day in the SPX, you will get a big spike up or a big spike down as the buy programs, the market on close orders come in. And it doesn't matter which one. When we had this short butterfly here, if the market fell, because sell programs were coming in, whoops, let me back up. If the market fell, I'm going to buy a call spread. If the market goes up, I'm going to buy a put spread to hedge. And then what happens? Here, the market went up. So I went and bought the put spread, and that created this. I was short the butterfly, and then the put spread on top of it creates a position that morphs into this. And what I end up with is when I buy a call or put spread with an existing short butterfly on, the net residual position is a long call spread or a long put spread. And so I went from having $3 of risk to being in a long put spread for a 50-cent credit. The risk graph shows 50-cent credit. Okay. Now, after I morphed into this, what happened? Well, most of the time, if the market's going up, it'll keep going up, which is what you want anyways. If you're short a butterfly and the market's at the center strike and it starts moving up or down, you want it to keep moving up or keep moving down to get away from that butterfly. Am I not right?
Absolutely.
So here, I said, I don't care. Maybe the 55.50 put spread's going to go out worthless. But if I buy it for $1.50, it's less than I have the butterfly on for, so I'll have a 50-cent credit, and the residual position's this. And yeah, it's probably going to go out worthless because usually when the market starts going, it keeps going. But once in a while, it reverses. And serendipitously, the market did reverse because a sell program came in. So let's blow up what happened in the last few minutes. And there you go. You see right here, well, right here at 14.50 is when we put the trade on. Somewhere around here. And then we had one shot up where I went in and bought the put spread. And had we gone down, I would have bought the call spread, and that would have done the same thing. And then at the last second, 3 or 4 billion came in to sell, and there was selling going on. And guess what? You saw the graph. You saw the graph was a synthetic long put spread left. So I put in an order to sell the synthetic long put spread. Hold a second. There we go. We had the last minute sell off. Then I put in an order to sell the put spread at lower strikes. You'll notice the green box is buying the 55.50 put spread. Now I'm selling the 50.45 put spread at $1.50 because we fell $5, which is nothing in the SPX, guys. We get $5 moves every couple minutes. So we went up. I bought the put spread for less than my butterfly. We went down one strike, and I sold the lower strike spread out at $1.50. What have I done? I've legged into the butterfly, and now you see the line below is a $200 profit guaranteed, and the risk is gone. And that's how Newton's straddle works. Now, you see the fill price in green of the long spread. I bought the 55 put for 185. I sold the 50 put at 35 cents. Had that 50 put been under, say, 10 cents, 10 cents, 5 cents, why sell it? A lot of times I'll just put an order into buying the naked call or the naked put instead of the vertical spread if the tail's not reducing the cost of my hedge. I mean, why would I sell the 50 put at a nickel? You're bringing in a nickel, and the commission on that thing is a buck, buck and a half. You're making $3.50. Seriously, why bother selling it and limiting your downside? So as the market started to fall, like you saw in the previous slide, I sold out the 50.45 put spread, and now all my risk is gone. Now, what freaks people out and why this is called the Newton's Cradle is this. Hold on a second. At the top is the short butterfly. At the bottom is the short butterfly after I bought the 55.50 put. Now, those red lines are not a butterfly. Okay, that's not the graph of a butterfly. I'm just pointing out the strikes of the long put spread I bought. Okay, I bought the 55.50 put spread. But what am I left with is a synthetic 50.45 put spread. So I'm buying a spread on one side of the butterfly, and it sort of kicks out a free spread on the other side of the butterfly, sort of like a Newton's Cradle movement. And like I said, if you guys want a copy of that recording, it's 34 minutes long. You can watch me do it real time. I'm probably more relaxed trading than I am talking to you guys. So I think you'll notice that I wasn't worried about it at all. I do these things almost every single day. It's a little bit tougher to do in a classroom or a Zoom recording or a GoToWebinar because you're instructing and trying to trade at the same time. Your attention's divided, but maybe once a week, I'm going to start doing it for a little while until people are very comfortable in the process.
Well, maybe an idea is you could record it and then you don't have to instruct, while you're trading, and then you can talk about it
Yeah, well, that would
later
be the
after.
intelligent thing to do, but you got to remember I'm a floor trader, Tom. I'm not an instructor. Okay.
Just an idea.
Okay. I mean, no, that would be the intelligent thing to do. But again, I'll do it the next time. The next time I do it, I will hit the record button. It's just usually it's something that occurs to me at the end of the day. It's like, oh, okay, there's 20 minutes left. Time to go to my end of day games.
Right.
Right now, the order imbalances are coming out. I'll get an indication if the market's probably going to jump higher or fall a little bit on the close. What do I want to do? What are the at the money options trading for? Do I have any risk at this area that I should clean up? If not, let's put some risk on and have some fun. The last thing I'm thinking about is I should hit the record button. So,
Yeah.
but the funny thing is the Simpsons, and I'm not a fan of the Simpsons, but my son is, keeps pointing out all the coincidences in life that the Simpsons predicted. Like they predicted Newton's cradle right here. And they predicted a lot of things in life, like, smartwatches, Siegfried and Roy getting eaten by a tiger, Higgs boson. The funny thing is they predicted the Higgs boson particle 11 years before it was shown to be similar to Homer Simpson's math.
That's pretty funny.
How cool is that? I mean, somebody working for the Simpsons is more than a cartoonist. He's like got a physics background.
Did
And
you know
then
that the guy that does the voice for Homer went to OPRF high school?
No,
Yeah, he went to Oak Park River Forest High School.
I had no idea. Well, the guy who created SpongeBob SquarePants, I taught options too.
Okay.
And I actually he did a painting of SpongeBob for my son when he was like 3 years old. Because he and I were talking and I was helping him out on the side. And he's like, what can I do for you, Scott? I'm like, my son really loves your show. You got any cells? And he goes, no, I don't have any of the cells. We only did the cells for a couple of years, but I'll make him a painting and send it to you.
That's
and it
great.
actually showed up.
Nice.
So anyhow, the great thing about this class is a lot of students embrace some form of vertical spread derivative, be it a butterfly, condor, unbalanced condor, broken wing butterfly, long or short. And even if you don't plan on being in a short condor or short butterfly, chances are you're going to end up in one day. And how to manage it and everything else is imperative. And I think if you know how to wiggle out of something that makes you uncomfortable, it makes you less uncomfortable. I have a lot of students that would never touch a short butterfly, and now they're looking to sell these things all day long. So
yeah, there was a guy in the option club Yahoo group years ago. His name was Michael Catalico. I don't know if that was his real name, but he was a floor trader. And he said a good exercise is to take any strategy that you like and trade both sides of it and make money on it, on both of them.
Correct.
Just think about it from both sides of it.
Correct. And then that's all I was doing when I was on the trading floor, and I showed you the picture of that pit, and it's like what it took for me to get comfortable taking the other side of vertical spreads. I had no problem taking the other side of any spread that anybody came in. Anytime a customer came in through a broker and said, what's the market on this call spread, this put spread, I'd give a two-sided market. I could figure out. If I didn't want to sell a put spread, I'd just box it off and be done with it. I had edge where I could at least box it off for even. I was very comfortable. Selling butterflies just didn't seem like the risk reward was there, even though mathematically I knew it was just as good to buy a butterfly for 30 or 40 cents as it was to sell it. From a risk versus reward and probability, there was no difference. It was a coin flip which side was better. That's why it was priced at 40 cents, because that's what it's worth. But it just made me uncomfortable because I figured I had bad luck. And that's where the market's going to close that day. And it took, that was the one strategy I had to get comfortable. That took a while for me to embrace.
Hey, Scott, there's a question for you. It says there's
Yeah.
a risk reversal spinning in the bottom of this slide. Is that relevant to short flies?
No, that was cut, taken out, and then when I shut it down, I didn't save the slides first, so it should have been gone. Because the last time I had this slide up was for your class when I was talking about risk reversal, so I just cannibalized this slide.
Makes sense.
Okay, so
I love risk reversals too. I mean,
I love risk reversals. We had one on. We haven't done one in a long while, and I started one a couple of weeks ago, and we just got out of it last week. You know, we sold it when the market got near 4,500, and we sold off down to 44 and change, and I took it off. So we actually entered a short delta risk reversal.
yeah, I usually call them either bearish or bullish to avoid confusion.
Because long or short delta doesn't do it.
Well, yeah, that does too. But if you say I'm long a risk reversal, people think you're bullish.
You know, I don't know if there's a bulletproof way of explaining anything that's going to avoid confusion for new people, especially because there's so many people out there that feel they have to create a new name for something existing. You know, I mean, when for example, the thing that frustrated me the most when I started teaching is on the trading floor, we'd call it a long put spread or a short put spread, or a long call spread or a short call spread. But all of a sudden I started teaching, and all the students are coming to me with, this is a bullish call spread or a bearish call spread.
Or put credit spread or put debit
credit
spread.
Yeah, it was like, where are you learning this non-standard lingo?
Probably
right?
Dan Sheridan.
Maybe. I don't know. I don't know where it was, but because everything on the trading floor is standardized. There's no one has 3 different names for the same thing, you know, because it would cause confusion and out trades cost money. But when I started teaching and meeting thousands of people a year, there was like 5 different names for everything. I didn't know where they were coming up with the stuff.
Yeah, and fundamentally, option spreads really boil down to just combinations of put spreads and call spreads.
Right. I mean,
those are the building blocks.
Right. I mean, well, obviously it starts the DNA, the 4 proteins are long call, short call, long put, short put.
Right.
But very few people trade naked options because you're playing with dynamite. Okay. Unless you're really, really good. And so most people have no problem with vertical spreads. And then, so that's sort of like the building blocks. And then from there, they get more sophisticated. They're more comfortable going to a butterflies, usually the next thing. Then they go to condors, and then the iron condors, and then mambo combos, which is also known as guts.
Where
you're selling in the money call spread and an in the money put spread. And it evolves from there, but the building blocks are always vertical spreads, exactly like you said, Tom.
Do you ever leg into your short flies like near the end of the day, or you just put them on as a package?
That's a tricky question to answer in complete honesty without giving you a 1-minute explanation. I will leg into short flies, but that was never my intention to start with.
Right.
Okay, on the close, I'll just throw it up as a package because most of the time, anything near at the money, people reach for it because they're panicking. They see the butterflies trading for 2, they're short it, and they're like, it's going to 5. I'm just going to pay and get out of it. I can't take the pain anymore. And they tend to pay more than I could leg realistically. They just reach for things. I mean, you see it's trading for about $2 on the screen. You put out 240, someone grabs it. You know,
Yeah.
I mean, this trade right here, it was trading for like $1.70 when I put the order in, and then said I'll just sell it at 2. And then about a couple minutes later, bing, sold at 2. Somebody reached for it. Now I will end up in short butterflies on a leg at the end of the day or throughout the day, only because I'm trying something else and it's not working, or I'm afraid that the market's stalled out and I'm going to reverse and I just turn it into a short flying, forget about it and move on. Because the best discipline I ever learned as a trader took probably 2 years because I'm kind of slow. But when you don't like a trade you're in, or it's not working out, just get out. Everyone holds on to a trade they don't like or is not working out forever. And then they're not religious people until they have a bad trade on. And then they're thinking, oh God, please get me out of this one. And I'll never trade the 50-55 call spread ever again in my life. You know, I bought it for $1. Just get me out at $1 and I'll never trade this strike again. And they're cutting deals with God. And now it goes to 80 cents and then 70 cents. And then at 30 cents, they give up and throw in the towel, or they'll just let it go out worthless because they're like, I lost everything already. Why bother? So me, I'm pretty quick. When I think the market's going to make a move and it goes against me on just a vertical spread, not a package like a Dragonfly or BWB or something, I let those breathe a lot more. But if I'm just scalping a vertical spread because I think we're going to bounce, let's say we're at 4,400 and I think we're going to bounce, I'll go in and buy a vertical spread. And guess what? If we break through and start hitting 33.90, obviously the support level's gone. Bam, I'll whack it and turn it into a short spread and just get emotionally detached from that trade. Otherwise, you're just not thinking clearly. So I'll end up with short spread or short butterflies because I'm hedging something off. But as a package, I'll just trade the butterfly as a package. If that's the intention of the original intention is getting into a short butterfly.
Right.
Now, if some of you guys are probably better traders than I am in terms of legging, and you know, if you can leg into a short butterfly that's trading at 240, you know, I don't see why you shouldn't do it, provided you're disciplined and you're not going to sell it at 20 cents when it goes against you instead of 240.
I guess the only argument against that is if you are going to be directional, just buy a futures contract.
Well,
No, if
that
you're
comes
good at
with its own
direction,
problems, obviously. I mean, every
course,
single
yeah.
strategy has its risk versus reward, and some people just aren't made for futures contracts.
Right.
You know, I mean, because they get mushy, right? They just jump. Some news comes out and they'll move $5, and that may be your stop, and then it goes right back.
Yep.
You know, it really, you have to know yourself as a trader and what your personality can accept in terms of stress. You know, I mean, you're better off almost with a wide call spread where the long options in the money.
All right. Well, I've got just 2 more slides. If we're gonna, I guess we're getting close to wrapping it up. So
Okay.
I don't see any more questions, but let me just share my screen real quick.
Yeah, I
Those
just wanted
last-
to share with them the 2 days that I'm going to be teaching what I'm teaching.
Right. So you should be able to see my screen now.
Yes, I do.
Okay, so and just a refresher of what's in the workshop. You get 6 weeks with the zero DT trade alerts that I run every day, and then a month access to Scott's pot class, which is really great, highly recommended. And then Wayne's doing his adapt daily options for 4 weeks, which is a pretty good deal too. And then, of course, you get access to the spreadsheets that I use, private discussion forums, a lot of Discord channel for it as well, if there's a demand for it. And then everything will be recorded with indefinite access. And then there is a link to start. It does start tomorrow, just a kickoff meeting. So we're not really going over any strategies tomorrow. It'll be more like a walkthrough of the class pages and what to expect as far as getting access to the classes and stuff. But let me just type this in the chat. That should work. Let me just test it on another window here. Let's see. Browser, where are you? There it is. Yes, that's the right link. Okay, so if you want to get more details about it or you're ready to sign up, then just go there. And I did add a 3-pay option. So if you wanted to spread it out over a couple months, that's fine too. So anyway, that's about it. So it starts tomorrow. Lots of great content, good speakers, and like I always tell people, if there's just one idea in there that can help your trading, it'll pay for itself. So it's a lot of great ideas floating around for this workshop, and like Newton's Cradle and the short butterfly, or like you said, Scott, most people don't trade the short side of things. They're doing the other side. So it's nice to learn about the other side of the trade that you're normally doing, and just think about it from a different perspective and how you make money.
Well, and taking what you just stated one step further, where you said that, if you just learn one thing, this class pays for itself. I've always told my students, and they're probably sick and tired of hearing about it, but had there been an optionetics or an arrow mirror or a stratagem trade or any of that stuff when I started on the trading floor, I would have paid $1 million for everything that they offered, because I lost a lot more money trying to figure that out on my own. And to learn just an adjustment like Newton's Cradle for condors and butterflies, and it works on the long butterflies too. Okay, instead of buying a vertical spread, you can, if you're long a butterfly, you can sell a vertical spread and take some money off the table. I do that as well. And you're going to see that in my class, where if you're long the butterfly, how many of you guys have ever been long a butterfly? It looks like it's going to close at the center strike, and all of a sudden, at the last second, it moves and goes out worthless. It's very frustrating. Well, part of Newton's Cradle works in reverse. Instead of buying a call spread or buying a put spread, you'll sell the call spread or sell the put spread, and you'll sell the call spread at $4 or the put spread at $4. And no matter what happens, you've gotten $4. Now, you may not make $5 on the butterfly, but I don't make $5 on any butterfly too often. And then if the market moves against you, where the butterfly would have expired worthless, at least you got $4. It works both ways. To learn that, I would have paid $50,000 when I first started learning the trade, because it would have saved me a lot of money over the long run.
Well, and as far as like learning new ideas and ways to do things, when I was young, I would play a game of chess with my dad every evening after dinner, and he would always kill me. And then I started reading books on chess, and slowly I got better and better. And at some point, I started beating him all the time. And my brother was like, "There's a lot of value in books. Learn and get new ideas. Don't just stay where you are."
Right.
It's like the definition of a fool is doing the same thing and expecting a different outcome. So,
I think a definition of a fool is someone who doesn't ask questions when they're confused about something, because
right.
you're never going to learn the answer. And that's, I'm sure this is why you teach, Tom, I've traded literally millions of contracts in my life. Literally millions of options contracts. There were days where I was trading 100,000 option contracts in a day. And I've learned, I thought I knew everything about trading until I started teaching people. And they started asking me questions. I'm like, you know what? I never even thought of this. And I've learned something a little bit new. I've been doing this since '86, and I'm still learning something new once in a while.
Right.
So I want to thank you guys for letting me teach to you, because you're still helping me learn.
Absolutely. And I really appreciate your friendship, Scott, and the great experience that you have, and hope people sign up and take advantage of it, because it's a wealth of information that you bring to the table.
Well, I appreciate you saying that, Tom. And you know, you've seen this before. We see the same names always signing up, and we know that those are going to be the ones who are going to end up winners, because they're just dedicated.
Right.
They're going to get this no matter what. They're going to learn this, and they're going to get good at this, even if they're not there yet, because they're determined. And so they will.
All right. Well, thanks everyone for coming. I'll get this recording posted. And if you're interested in learning with us with the workshop, it starts tomorrow. Again, tomorrow is just a kickoff meeting, so we won't really be starting in with any strategies until Wednesday. That's when Dan Harvey and Alec will be going over the narrow iron condor. But we'd love to have you join us, and hopefully we'll see you there. If not, keep trading, doing what you're doing, and yeah, just have a great weekend, whatever's left of it, and good trading next week. And thanks again, Scott, for helping out. Really appreciate it.
No, this is more fun than what I'm doing next. I got to go Costco next. I hate that place.
Oh, all right. Well, good luck. It's Sunday. Everybody's going to be there.
That's what I hate about it. That, and I go there for 5 things, and my shopping cart has $800 in it.
Yeah. Yeah. All right. Well, thanks again, everyone, and we will see you soon.
Take care.
Scott.
Thanks, everybody.